Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Yesterday, February 23, 2026, Phaos Technology Holdings, ticker POAS on the NYSE American, closed at approximately 98 cents. We are staring directly at a sub $1 stock.
Right, and we have to immediately contextualize that price with the volume. We are seeing an average of 3.68 million shares traded daily. Let's be clear about what that number implies. That is not the footprint of steady, thoughtful institutional accumulation. That is the chaotic signature of high-frequency retail speculation. We're talking about a stock that crashed from an all-time high of $7.39 on February 4th down to an all-time low of 53 cents just 8 days later on February 12th. That is a 92.8% vaporization of value in a little over a week.
It is violent volatility. There is absolutely no sugarcoating the charts. I mean, it looks like a heart attack. But the question we are here to debate today is not about the disaster of the past 8 days. It is about the potential of the next 10 years. Is this a distressed microcap holding a misunderstood revolutionary technology that presents a 10-year 5x opportunity? I will be arguing the bull case today, taking the position that their optical nanoscopy technology is fundamentally mispriced.
And I will be arguing the bear case, taking the position that this is a severe going concern risk characterized by a 91% revenue collapse, a massive leadership vacuum, and frankly, technical insolvency.
Okay, let's just jump right into the positions then. I think we really need to start by stripping away the market sentiment, the fear, the algorithmic trading. We have to look at what this company actually owns. The market is completely mispricing the fundamental intellectual property here because, well, they are distracted by the ticker tape. Phaos is not a fly-by-night shell company cooked up in some garage. This is a spinoff from the National University of Singapore and US. It is built on years of rigorous peer-reviewed research by Professor Hong-Ming Wei. The core asset, the moat, is their patented optical microsphere nanoscopy, or OMN, technology.
Pedigree is great for a slide deck, I will give you that.
It is more than just a slide deck, though. It bypasses the Abbe diffraction limit. For over a century, since 1873, optical microscopy was held back by this physical wall. You generally could not resolve features smaller than 200 nanometers using visible light. Light waves are just too clumsy. But Phaos achieves 137 nanometer resolution using visible light. They are democratizing super-resolution microscopy. Instead of a lab needing a massive dedicated room and a $500,000 budget for a Zeiss or Leica system, Phaos offers a nanoscope upgrade for standard equipment. They are targeting the massive semiconductor and biomedical markets. The current price is just a panic-induced entry point for a stock with a very clear path to a $140 million valuation, which is roughly 5x its current cap.
I hear the physics argument, I really do. But I am here to argue that revolutionary technology is functionally irrelevant if the corporate entity housing it is technically insolvent. You can't commercialize physics if you can't pay the electric bill. NUS is a world-class university. Yes, but the public markets are a very different beast. Academics don't always make great capitalists. We have to look at the catastrophic financials for the fiscal year ending April 30th, 2025. Revenue didn't just dip, it collapsed. It fell 91.1% to a mere $167,707, down from $1.88 million the prior year.
The revenue drop is severe.
It is a total evaporation. How does a company with supposedly revolutionary technology go public and simultaneously see its revenue drop to the price of a single luxury car? And alongside that $167,000 in revenue, they posted a net loss of $3.93 million. They are sitting on negative shareholder equity of $1.13 million. Their liabilities exceed their assets. But the biggest red flag? Governance? On December 31st, 2025, both the CEO, Andrew Yoen San, and the COO, Tae Bang Boon, resigned simultaneously. Just 6 weeks after the IPO. When the captain and the first mate jumped ship 6 weeks into the voyage, this is a falling knife with no permanent leadership and no confirmed sales engine.
I want to push back on that falling knife analogy by going deeper into the technology itself. Because if the tech truly works, the leadership issues are solvable, You mentioned the revenue collapse, but we really need to understand the product cycle. The technology relies on the photonic nanojet effect. This is not simple magnification. It is not just slapping a better lens on a tube.
Right, but explain that. Because to investors, photonic nanojet sounds exactly like a buzzword from a sci-fi novel. It sounds like hype.
It sounds like hype, but it is hard science. Here's the simple version. When light hits an object, there are propagating waves that travel to your eye, and then there are evanescent waves that stick to the surface and die out immediately. Those evanescent waves hold all the high-resolution details, the tiny cracks, the minute structures. Standard microscopes simply cannot see them because the waves don't travel. Phaos places high refractive index microspheres directly on the sample. These spheres act like a bridge. They capture those whispering, evanescent waves and convert them into propagating waves that a normal lens can actually see.
Okay.
It effectively turns the sample itself into a magnifying element. They have specific product lines for this, like the OptoNano 200 launched in 2020 and the PT Metrology series. And the semiconductor market desperately needs this. We are talking about an industry selling 1 trillion chips annually. As chips get smaller, moving to 3 nanometers and beyond, the need for high-resolution, non-destructive inspection tools is absolutely critical.
But the industry standard is the electron microscope. That is what they use.
Exactly, the scanning electron microscope, the SEM. But here is the pain point. To use an SEM, you have to put the sample in a vacuum. That takes time to pump down. It slows the entire production line. And for biomedical, a vacuum kills the cell. You cannot study living biology in a vacuum. Phaos provides this resolution without the vacuum requirements of an SEM. You can inspect a silicon wafer or a living cell in ambient air. That speeds up the line, and time is literally money in chip manufacturing.
I am not disputing the physical mechanism. It is like putting a cup against a wall to hear the conversation in the next room. I get it. But counter that with the revenue reality. If this niche is so high value, where are the orders? If the tech is as revolutionary as you claim, why did revenue drop to $167,000? If Phaos had a killer app for chip inspection, they would have a backlog, not a rounding error on a balance sheet.
Well, they're positioning as a budget alternative, a democratized.
And that budget positioning might be their fatal weakness. Competitors like Zeiss with their LSM 990 or Nikon with the AXR, they completely dominate the high-end space. The big fabs trust them, and there is a massive technical limitation risk here that you are glossing over. OMN is a physical, hardware-based solution. It requires placing a physical microsphere on a delicate sample. That is fiddly. It introduces contaminant risk on a clean room floor. The entire industry is moving toward AI and computational super-resolution. It is software-based. Why would I fiddle with placing tiny glass spheres on my wafers when I can just use a software algorithm to enhance the image?
Because software has fundamental physical limits. You cannot enhance data that is simply not there. In the AI world, that is called hallucination. If you ask an AI to upscale a blurry image of a defect on a 3 nanometer chip, it might guess wrong. And in quality control, a wrong guess costs millions of dollars in ruined wafers. Phaos captures the near-field data, the actual physical information that software simply cannot invent.
But the industry doesn't seem to care yet. Phaos has zero analyst coverage. None. That strongly suggests the institutional semiconductor industry does not take them seriously as a disruptive threat.
Or it suggests they are a microcap that the street hasn't noticed yet. That is why the alpha exists. Phaos isn't trying to replace the $1 million Nikon rig in a Tier 1 R&D lab. They are targeting the industrial line, the quality control manager who needs a quick, high-res check without stopping the line for a vacuum cycle.
Let's pivot to the corporate stability then, because you cannot execute a sales strategy to those quality control managers without a CEO. I have to press on these resignations, citing personal reasons simultaneously for both the chief executive officer and the chief operating officer immediately post-IPO is highly suspicious. It just is.
It is definitely terrible timing. I won't argue that.
It is beyond terrible timing. It is a massive red flag, and now they are completely reliant on an interim CEO, Gan Hongloon, during a severe liquidity crisis. An interim leader during a crisis is a recipe for disaster. Who is negotiating these complex semiconductor contracts? Who is raising the next round of capital? You need a wartime general right now, not a substitute teacher. And look at their defensive regulatory filings. In February, under Section 401D of the NYC Company Guide, the company essentially issued a statement claiming, "No material development explained the stock's volatility." That silence creates deep distrust.
I view the structural roots of the company a bit differently. Yes, the C-suite is in transition, but the licensing relationship with NUS Enterprise provides a solid layer of stability and R&D continuity. The scientists, the people who actually build and understand the nanojet effect, they are still there. The IP is secure. And despite the executive turnover, their strategic pivot is actively happening. Just weeks ago, on January 31st, 2025, they announced they are expanding sales offices into Vietnam, the Philippines, and Indonesia.
Opening a sales office is easy. It is literally just renting a desk. Closing a sale is the hard part. Why burn cash on rent in 3 different countries when you have zero revenue engine at home?
Because of where those offices are, they aren't opening vanity offices in London or New York. They are moving into the heart of the Southeast Asian manufacturing boom. Vietnam and the Philippines are becoming the new factories of the world for electronics packaging and semiconductor testing. By positioning themselves there, Phaos is moving away from just being a Singaporean academic spin-off. They are physically moving to where the chips are being packaged today. That is a signal of aggressive commercial intent.
That expansion costs real money, though. You have to staff those offices, you have to travel, you have to market, and that brings us to the most critical point: market mechanics and solvency. Let's talk about the cash runway. They raised $10.8 million in the IPO. That sounds like a decent cushion until you look at the burn rate. They had negative cash flow from operations of $2.8 million. With negative equity already on the books, that IPO money is going to burn incredibly fast.
They are distressed. I acknowledge that at the top.
They are technically insolvent on a balance sheet basis. If they are spending money to rent desks in Jakarta while generating no revenue, they are just accelerating the end. They are drilling a hole in the bottom of the boat to let the water out. To survive this, they will likely have to sell more shares. That means massive dilution for current holders. And look at who holds the stock. Institutional ownership is negligible. It is sitting at 0.76%. The top holders are algorithmic traders, Citadel Advisors, Hart Financial. These are not long-term believers in optical nanoscopy. They are scalping the volatility.
I acknowledge the dilution risk. Absolutely. It is a real threat. But let's focus on the valuation math for a second, because this is an asymmetric bet. To achieve a 5x return from these levels, to get to a market cap of roughly $140 million, they don't need to conquer the world. Assuming a price-to-sales ratio of 5.0, which is pretty standard for growth-stage medical and industrial devices, they only need to generate about $28 million in annual revenue.
You say only $28 million so casually. They are currently at $167,000. You are asking for a monumental, near impossible percentage increase in revenue. That isn't a turnaround, that is a resurrection.
I am asking for them to return to a functional scale and then grow. The 167,000 figure looks like a temporary, albeit severe, anomaly caused by the distraction of the IPO process and the leadership shuffle. If they can just prove that was a hiccup and return to even $1 to $2 million in revenue, the re-rating on this stock will be massive. Technically, the stock is deeply oversold. The RSI is sitting at 26.7. It seems to be finding a floor around the 88-cent mark. The panic selling over the last week has flushed out the weak hands.
It hasn't flushed out the weak hands, it has invited the sharks. Those algorithmic funds will dump the stock the absolute second the momentum slows down. Even if the market cap goes up to $140 million, the share price might stay exactly where it is because they had to issue millions of new shares to keep the lights on. The pie is just being cut into smaller and smaller slices.
If they capture in a tiny fraction of the manufacturing inspection market in Southeast Asia, the current $28 million market cap will look absurdly low in hindsight.
You are betting entirely on if. I am looking at is. The reality is that they have negative equity. The reality is that they have an empty C-suite. The risk of delisting is very real. If it stays under $1 for too long, the NYSE American will kick them off. And the probability of bankruptcy is significantly higher than the probability of a 5x return.
Well, let's bring this to a close and summarize where we stand. I see Phaos as a classic deep tech, high risk, high reward play. The physics of works. They broke the Abbé limit, and that has intrinsic value. The market for semiconductors and bioimaging is growing rapidly. The bet here is that the new sales offices in Southeast Asia will restore the revenue engine. If they can survive this current liquidity crunch, the upside is substantial.
And I summarize my position by saying the financials are currently disqualifying. A 91% revenue drop and an empty C-suite make this uninvestable for prudent capital. The risk of delisting or bankruptcy completely overshadows the technology right now. My final thought is that investors should stay on the sidelines, wait for a permanent CEO, wait for a quarterly report that shows actual revenue growth before touching it.
I think we can both agree that the next 6K filing is going to be the absolute deciding factor here.
Absolutely. That document will tell us if they are actually selling microscopes or if they are just selling shares.
We will leave it there. We encourage everyone listening to read the full equity report, look at the patents, and form your own conclusions.
And definitely check the balance sheet while you're at it.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.